Welcome to the King of Business. In this space, we explore the strategies, stories, and secrets behind the world's most successful companies. Here we break down complex business tactics and analyze both the triumphs and failures that have shaped the global economy. Get ready to embark on a journey of knowledge that will empower you to make informed and bold decisions on your own entrepreneurial path. How tech concentration sank the economy vertical bar. The dot-com bubble burst. The tech bubble of 2000, commonly referred to as the dot-com bubble, was an economic phenomenon that took place between 1997 and 2001. This period was marked by unprecedented euphoria surrounding tech and internet companies, leading to astronomical valuations for companies with unproven business models. The bubble burst in March 2000, setting off a series of events that culminated in a significant market correction and profoundly affected the global economy. Here is a detailed description of the background, rise, collapse, and lessons learned from this phenomenon. In the 1990s, the world witnessed unprecedented technological advancement. The advent of the World Wide Web and its rapid adoption transformed how businesses and consumers interacted. The internet became a global platform for commerce, communication, and entertainment. Tech companies began to emerge, promising to revolutionize entire industries and create new business opportunities. This context of constant innovation and rapid technological expansion laid the foundation for the dot-com bubble. The explosive growth of the internet led to the emergence of numerous startups known as dot-com companies, whose business models were based on leveraging the growing popularity of the web. These companies quickly attracted the attention of investors eager not to miss out on the new economy. Enthusiasm for these new opportunities led to massive investment in the tech sector, often without rigorous evaluation of the underlying business model's viability. Venture capital firms played a crucial role by providing funding to promising tech startups. Between 1995 and 2000, venture capital investments in the tech sector grew exponentially. Additionally, many of these companies went public, raising additional capital through IPOs. The IPO of companies like Netscape in 1995 marked the beginning of a frenzy for tech stocks. Money flowed freely into startups, many of which had no clear path to profitability. Widespread optimism about the potential of the internet led to inflated valuations. Wall Street analysts, driven by financial incentives, aggressively promoted tech stocks, creating market euphoria. Many retail investors also joined the frenzy, investing their savings in these companies without adequately considering the risks. The belief was that any company with an innovative idea and an internet presence could become the next big thing. Despite massive funding, many dot-com companies lacked sustainable business models. Some did not generate significant revenue and relied on continuous investment to survive. The belief was that over time, these companies would find ways to monetize their user bases and platforms. This approach led to a grow fast at any cost mentality, prioritizing user acquisition and expansion over profitability. The NASDAQ index, heavily composed of tech companies, reached its peak on March 10, 2000, at 5,048.62 points. This peak represented spectacular growth compared to its mid-1990s value. However, this extreme valuation was not supported by the economic fundamentals of many of the companies included in the index. The entrepreneurial culture of Silicon Valley during this period was characterized by an unrestrained spirit of innovation and a willingness to take big risks. The phrase, "get big fast," became the mantra of many companies, driving aggressive expansion at the expense of profitability. Companies were more focused on capturing market attention and increasing their user base than on building sustainable businesses. Starting in March 2000, the market began to show signs of instability. Concerns about excessive valuations and the sustainability of tech companies led to a massive sell-off of stocks. Within weeks, the NASDAQ began to fall, and many dot-com companies saw their stock prices plummet. Investor confidence quickly eroded, exacerbating the market collapse. As the market correction intensified, many companies were unable to continue operating. Companies like Pets.com, Webvan, and eToys, which had been rising stars, declared bankruptcy. This collapse resulted in massive layoffs and a loss of confidence in the tech sector. Overnight, success stories turned into tales of failure, with thousands of employees losing their jobs and their dreams. The collapse of the tech bubble had a devastating impact on financial markets. The loss of value in the Nasdaq is estimated in the trillions of dollars, affecting both large institutional investors and small retail investors. The market correction also triggered an economic recession in the United States and other parts of the world. Confidence in tech investments plummeted, and the flow of capital to the sector sharply decreased. After the collapse, the tech sector experienced a period of consolidation. Only companies with solid and sustainable business models managed to survive and thrive. Companies like Amazon and eBay, which had built loyal customer bases and generated consistent revenue, emerged as market leaders. This period also saw a re-evaluation of business strategies and greater prudence in tech investment. One of the most important lessons from the tech bubble is the need for rigorous risk assessment. Investors learned that enthusiasm and hype are not substitutes for solid fundamentals. The bubble highlighted the importance of carefully analyzing business models, revenue streams, and growth prospects before investing. This lesson has influenced investment practices and led to greater caution in startup funding. The collapse also led to greater regulatory attention on financial markets and analysts' practices. New regulations were implemented to improve transparency and accountability, aiming to protect investors and prevent future speculative bubbles. The Sarbanes-Oxley Act, enacted in 2002, introduced significant reforms to improve corporate governance and the accuracy of financial reporting. Despite the collapse, technological innovation did not stop. In fact, the post-bubble period saw the emergence of new technologies and companies that would continue to transform the world. The rise of social media, smartphones, and cloud computing in the 2000s and 2010s is a testament to the tech sector's resilience and adaptability. Companies like Facebook, Apple, and Google emerged as tech giants, driving the next wave of innovation. Pets.com is one of the most iconic examples of the dot-com bubble. The company sold pet products online and became famous for its mascot and spokesperson, a sock puppet dog. Despite massive investment in advertising, the company never achieved profitability. It launched its IPO in February 2000 and declared bankruptcy just 9 months later, in November 2000. This case is a reminder that a good marketing campaign does not always translate into financial success. Paul Allen, co-founder of Microsoft, invested millions in a company called Metrocom, which promised to provide high-speed wireless internet in metropolitan areas. Despite significant investment in promising technology, Metrocom failed to scale its business and declared bankruptcy in 2001. This failed investment shows that even technological visionaries can make mistakes. During the dot-com boom, domain names became a type of virtual real estate. Speculators bought common domain names hoping to sell them at high prices. A notable example was the sale of business.com for $7.5 million in 1999. While some of these names generated large profits, many others quickly devalued when the bubble burst. The fear of the Y2K effect, the potential problem at the turn of the millennium due to date coding and computer systems, led to large investments in technology in the late 1990s. Many companies upgraded their computer systems and bought new hardware, contributing to the tech stock boom. When the Y2K effect proved largely harmless, some of these investments were reduced, contributing to the start of the bubble's collapse. During the tech bubble, there was a brain drain to Silicon Valley, with talented professionals from around the world moving to the region in search of opportunities in the tech sector. However, when the bubble burst, many of these professionals found themselves out of work and facing economic difficulties. Some returned to their home countries or moved to other industries, bringing valuable lessons learned. The collapse of the tech bubble not only affected the United States, but also had global repercussions. The massive decline in tech stock values led to a reduction in investor wealth, which in turn decreased consumer spending. This contraction in consumption had a ripple effect across various economies, contributing to a global recession in the early 2000s. After the collapse, there was a re-evaluation of business models in the tech industry. Companies that survived and thrived post-bubble were those that managed to build more sustainable and profitable business models. The ability to generate stable revenues and maintain sustainable growth became a crucial criterion for investors. The crisis also pushed tech companies to focus more on innovation and operational efficiency. Competition intensified, and only those companies that could offer truly innovative and efficient products and services stood out. This led to the development of more advanced technologies and the creation of new markets and business opportunities. Despite the downturn, the entrepreneurial culture and venture capital investment in Silicon Valley and other tech hubs did not disappear. In fact, the lesson learned was that venture capital remained a vital source of funding for innovation, but with a greater focus on the viability and sustainability of business models. The debacle also incentivized greater due diligence by investors. The dot-com bubble experience also underscored the importance of adaptation and resilience in the business world. Many companies that initially failed with their original business models pivoted to new strategies that allowed them to survive and prosper. For example, Amazon, which initially focused on online book sales, expanded its product and service offerings, including the creation of Amazon Web Services, AWS, which became a cornerstone of its long-term success. The Sarbanes-Oxley Act, enacted in 2002, was a direct response to the tech bubble collapse and other corporate scandals like Enron. This law introduced strict requirements for transparency and corporate accountability, including the certification of financial reports by company executives and the implementation of rigorous internal controls to prevent financial fraud. The bubble's burst also led to increased awareness of the importance of ethics and transparency in business. Companies began to adopt stricter codes of conduct and implement more robust policies to ensure integrity in their operations and their relationships with investors and other stakeholders. Despite the collapse, the following decade saw the emergence of companies and technologies that transformed the tech landscape. Companies like Google, founded in 1998, but went public in 2004, and Facebook, founded in 2004, emerged as leaders of a new generation of tech companies. The evolution of smartphones, driven by the launch of Apple's iPhone in 2007, and the expansion of cloud computing were examples of how technological innovation continued to flourish. The bubble's collapse also changed consumer perception and behavior towards tech companies. Consumers became more discerning and began to value quality, reliability, and utility in tech products and services. This shift in attitude pushed companies to focus more on customer satisfaction and delivering real value. The burst of the tech bubble in 2000 was a complex event that left lasting lessons for investors, entrepreneurs, and regulators alike. It underscored the importance of business model sustainability and viability, the need for rigorous risk assessment, and the relevance of ethics and transparency in corporate operations. As technology continues to advance and new potential bubbles form in different sectors, the lessons learned from the dot-com bubble remain crucial for guiding responsible and sustainable growth in the business world. And so we conclude today's topic. I hope the information and insights shared have provided you with a new perspective on the business world. If you found value in this content, don't forget to subscribe and turn on notifications to not miss our upcoming episodes. Thank you for joining us on this journey of learning and growth. Until next time, keep pursuing your entrepreneurial dreams with passion and determination.